Hi guys, in this video we'll have a look at tax and other pay deductions. So what is tax? So tax is money collected by the government to pay for public services such as hospitals, education, transport, the police and defence forces. So the Australian Tax Office collects that tax. Now the federal government collects income tax usually on a regular basis. Depending or not if you have a business. Business owners might pay maybe every 3 months or right at the end of the financial year. It all depends. But if you get a wage or a salary, you pay a system such as pay-as-you-go tax, and that might be deducted from your pay every fortnight. It all depends on when you get paid. So the following table is the most current tax table, and your taxable income is calculated by the things on the right hand side. Excuse me. So for instance, if you earn $35,000, you need to locate yourself in this bracket. So if it was $35,000, these are the conditions that you have to follow. Just say you earn $83,000. Well, $83,000 lies there. And these are the conditions that you have to follow. Your income before tax is called gross income, and the net income is your income after all your deductions. So tax is a type of deduction. There are many others, and we'll have a look at that in a minute. Now, a tax deduction is this. A builder might purchase tools for his trade, and an educator or a teacher might have whiteboard markers. So whatever tool you buy for your occupation, and if you use that for your job to get paid, you can deduct that from your taxable income. So tax deductions lower the taxable income. So at the end of the financial year, you might be eligible to get a refund. To work out your taxable income, you calculate that by getting your gross income and you subtract all your deductions. So your tax deductions, it could be tax, it could be any other items that you use for work. Now, Medicare levy is also something we have to pay. And the Medicare levy is just a tax that pays for medical expenses. It used to be 1.5%, but now that has increased to 2%. And there's an important note that you have to take into consideration. So if you have anything that's taken out of your pay, so a deduction, you must have a written agreement between yourself and the employer if there's going to be anything taken out other than tax. Another deduction is superannuation. Superannuation is basically a fund that you get at the end of your career. So when you retire at a certain age, you get either a lump sum or regular installments. It depends on what you choose. And it's going to increase to 12% by 2019. You can actually put your own voluntary contributions to your super to increase that, but you don't have to. Net income. So the net income is the amount of money you have after all your deductions are taken out. And you calculate that by your gross income and you subtract all your deductions. So your tax, your voluntary super, and any other deductions. Alright, let's have a look at a particular question, looking at a tax table. So if your gross income is $86,000, let's work out two questions. One, the annual income tax, and two, the annual net income. So $86,000 lies in that certain section. It's between $80,001 and $180,000. So these are the conditions that you have to follow. So the annual tax payable is $17,547 plus 37 cents for every dollar over $80,000. So to work out the amount over 80,000 is the difference between 86 and 80,000. So that works out this part. And 37 cents in that amount of money is 0.37 multiplied by that difference. And then you add your $17,000 to that. So this particular thing here, you can do that straight on your calculator. So 0.37 times 6,000. Or if you want to work it out like that, you need your brackets. That works out to be 2,220. Add that to your 17,000. And then you get 19,767. So if you earn $86,000, you end up paying close to $20,000 in tax to the government. Now, how much do you end up with? Well, you started off with $86,000, subtract your tax, and you end up with $66,233. Okay, question 2. If you want to have a go at this before I put the answer up, just pause the video now and attempt this question by yourself. And I'll go through it now. So Drew earns a fortnightly gross income of $1,260. We want to calculate two parts. The first part is the tax that's deducted each pay. So there's an important point here. This table works out the annual or the tax in a whole year. So we want to work out each pay. So that's every fortnight. So we have to do a little bit of manipulation. And the second question is the net income for each pay. So how much do you end up with every fortnight? So the gross income for a whole year, so the annual gross income, is how much you get paid per fortnight and multiply it by the number of fortnights in a year. And it's stated in the question that we're going to assume that there's 26 fortnights in a year. That calculation gives us 32,760, so that's how much Drew earns in a year. The tax payable in a year is going to be, so you have to work out which part of the table we're going to calculate that from. So that is going to be 32,760, so it's going to be the second line. So it's 19 cents for every dollar over 18,200. So doing that calculation, you end up getting $2,766.40. Now, to calculate the fortnightly tax payable, you get your annual tax payable and then you divide that by the number of fortnights, which was dividing it by 26. So this works out to be $106.40 that is paid every fortnight to the government. So how much do you end up with each fortnight? Well, it's your fortnightly pay, $1,260, and you subtract your $106.40. So in the hand, sometimes they say in the hand, so your net income is $1,153.60. Okay, our third example is Sally, who's an accountant. She earns an annual gross salary of $81,000. Throughout the year, she purchases work-related items totaling $1,900 and union fees for $560, and she's donated money to charity that comes to $1,100. Two parts: calculate the tax income, that's for the year, and part B, calculate how much income tax she should have paid. Okay, so part A, taxable income is $81,000 minus all her deductions. So that's one of her deductions, $560 are her union fees, and $1,100 goes to charity. So the amount of money that would be taxable would be the difference there. So she has a taxable income of $77,440. So what that means is she's taxed on that amount. All the other items are not taxable because she paid that for her work. The annual tax payable, so that's $77,000, which belongs in that one. So I should say that one. So it's $3,572 plus 32.5 cents for every dollar over $37,000. So that's $3,572 plus all of this works out to be $13,143. Add them together and you get $16,715. So that's how much income tax she should have paid. Okay guys, thanks for watching.